In this week's video, we'll review the latest charts and data to help us answer the question, will a recession stick a fork in the bull market? We'll cover numerous scenarios this week, including the severe recession scenario. And keep in mind, none of this is particularly useful if we're not able to review the data and the charts objectively. As we've mentioned numerous times in recent months, we're living in a different world. And that new world will most likely feature higher inflation relative to what we've all grown accustomed to, and higher interest rates. And history says from time to time, most likely that will translate to higher volatility in the financial markets. Thus, in the coming years, it's going to be more important than ever that we have the ability to review the data in an unbiased, unemotional, and objective manner. We want to make sure that we're trading the charts in front of us and we're reviewing the data sets in front of us. So let's talk about two different topics: odds of an imminent recession and the odds of a recession in the next 18 months. Historically, these are the data sets that matter relative to the declaration of a recession. And in early to mid-August 2023, these are all fresh charts. The data sets in front of us do not look recessionary. That may change, but it hasn't changed yet. And if we review a weekly chart of the S&P 500, chart dated August 8th, very difficult to look at this trend here. 10-week moving average, the 20-week moving average, and the 40-week moving average in green. It's very difficult to make the argument that the market is forecasting an imminent recession. And given the market has moved a long way in a relatively short period of time, it's well within reason that the market could come back and retest these bases here. It's one of the reasons why we established positions weeks ago, because the closer we are to these long-term bases, theoretically, the lower our risk. This is all potential support back here, and at a minimum, it's a very relevant reference point relatively close by. It's a daily chart of the S&P 500, anchored volume weighted average price. Also tells us potential support in this area here around 43.18, and then another band comes in between 42.35-ish and 4100-ish. We'll see how it unfolds. It's always important to have realistic expectations about how markets operate in the real world, and it's possible for newer clients that any type of normal pullback or correction will offer a more attractive entry point for new capital. The data that we have in hand is not screaming imminent recession. However, given topic A up here and topic B here, it wouldn't be shocking if we did see a recession sometime in the next 18 months. Thus, it's logical to ask and answer, would a recession negate the secular trend thesis? And if we're going to make good decisions walking forward, it's best that we do that in a cool, calm, and collected manner. We've been talking about the secular trend thesis for several weeks now. There's two main windows, 1950 to 1973, with the strongest part of that secular trend being in the 1950 to 1968 window, and the second window, 1982 to 2000. Thus, relative to this question, this is a logical place to start. How many recessions occurred in the 1950 to 1973 and 1982 to 2000 secular trend windows? Answer: 5. Yes, 5. Telling us from a historical perspective, the answer to this question is a definitive no. From a risk management perspective, you always have to think about the worst case scenario. So let's assume that inflation and interest rates continue to be a problem in the next 18 months, and that results in a debt crisis of epic proportions. How would we handle that? By waking up every day with a flexible, unbiased, and open mind, trading the charts in front of us, and taking it day by day. We know from numerous perspectives the present day is similar to 1989. Thus, this is what the secular trend looked like from 1989, lower left-hand corner, all the way up to the year 2000, upper right-hand corner. Now, if something like this were to happen in the next 18 months, it's highly unlikely that the present-day charts would look anything like this. In fact, they would probably look a lot more like this. And it's pretty easy to see that the left side of this chart over here looks discernibly different from the right side of the chart. During the strongest parts of the secular trend, price for the most part stays above the Bollinger Bands, and when there's pullbacks, that typically occurs within the bands. And when we move outside the bands, it's telling us we should be paying closer attention. And the reason why these concepts are relevant, if something like this happens, then it's very possible something like this could happen. In terms of our strategy walking forward, we're always going to be comparing present-day data to the base case, the secular trend thesis. Do the charts and data sets in front of us align with the base case, or do they contradict the base case? This looks like a secular trend here. This does not look like a secular trend. Now let's take a step back on the contingency planning trail. And let's assume a little bit more muted outcome. Garden variety recession in the next 18 months. Kind of a noisy looking chart here. Simple pattern recognition. S&P 500, it's a monthly chart, so we're looking at it at the end of the month. 30-month moving average in red, 20-month moving average in green. Bollinger Bands here and here. If we examine the right side of the chart, it shares some characteristics with April of 1989. And if you know economic history, you know there was a recession from July of 1990 to March of 1991. And I can assure you, after the 1987 crash, number one, not many people believed that the S&P 500 was going to rally for approximately 12 years. To the contrary, there's a lot of talk about the entire system being unstable in this window. And thus, like 2023, people were worried about the possibility of a recession. And eventually, there was a recession. In recent weeks, from numerous perspectives, we've made the case that 2023 shares some characteristics with 1989, including the look of this chart here. So let's assume in the present day we're overly concerned about an imminent recession, despite the fact that the charts in front of us and the economic data sets in front of us do not align with the imminent recession theory. And let's assume that you did that in 1989. How did that work out? In this window here, the charts have improved significantly between point A and point B, just as they have in the present day looking back to the October low. So in 1989, if you ignored the charts in front of you, despite the fact that a recession was coming, it didn't work out particularly well. We just said that the S&P 500's present-day monthly chart looks similar to the end of April 1989. From April 30th, 1989, to the peak on the daily chart in July of 1990, the additional gain for the S&P 500 was approximately 19%. The NASDAQ 100 tacked on an additional 23%. Reminding us the importance of making rational and calm decisions in the present day. A lot of worry about a recession in this window here. It finally is anticipated by the markets, and we do get a fairly significant drawdown. That's the bad news. The good news is it absolutely positively did not derail the secular trend. Price made a stand at an upward sloping 30-month moving average, well above the 50-month moving average, and that speaks to the strength of the trend in this window, and maintained a secular bull look walking forward. And relative to all the worry about a recession in this window here, while the S&P 500 was gaining approximately 20%, recessions are declared after the fact. Ultimately, the recession window was determined to be July 1990 to March of 1991. However, that declaration was not made until April 25th, 1991. So we don't officially know that we've had a recession until several months after the stock market bottomed. So if you're worrying about a recession way back here, that was not particularly helpful. And if during this decline you continued to worry about a recession even after the market started to improve, that wasn't particularly helpful. As we all know, the market's a forward-looking mechanism, just reinforcing the importance of trading the chart in front of us. So on April 25th, 1991, it's announced that a recession began in July of 1990. And at this point, they don't have an end date for the recession. And here's a press release, April 25th, 1991. It's a little bit ironic that on April 25th, 1991, they declared that a recession began in July of 1990. At this point, they've not declared that the recession is over. But eventually, on December 22nd, 1992, the S&P 500 is way out here. With the benefit of hindsight, they declared that the recession ended in March of 1991, meaning it was over on April 25th, 1991. When in doubt, keep an eye on price. Thus, some similarities between the end of July and April 1989. In April of 1989, a recession was coming, but the stock market gained approximately 20% before that became a problem. Also noteworthy, ignoring the charts before the recession was not particularly helpful, and staying overly concerned during the recessionary window and ignoring the strong bullish trends that had been reestablished also was not particularly helpful. 3 years out from April of 1989, the S&P was up approximately 33%. The NASDAQ 100 was up 51%. 7 years later, big numbers. In this segment of the video, we'll continue to look at some of the tools that we'll be using to help us answer this question, to better understand this scenario, and to enable us to continually ask and answer, does it still look like a secular bull market? So here we're just illustrating basic concepts. It's a monthly chart of the S&P 500, 1989, 1990. Just talked about 1990. Here's your recession drawdown. So this is what increasing fear looks like. Price below the moving average envelopes rolling over in a concerned manner. And as we know, that did not kill the bull market. In fact, price staying below the moving average envelopes for a short period of time, that's bullish. Very similar to this look in here, a short stay followed by significant gains. This is the type of look that we want in here if the answer to this question is yes. And we can also use this tool scenarios where risks would increase significantly. This really doesn't look anything like this. All of these tools, the present day, we want to be able to ask in an objective manner, does the present day look like this? Or does the present day chart look more like this after the recession in 1990 and after the market had made a bottom and was resuming the secular trend? Do we have a rollover look? Do we have a rollover look? Do we have a turning up and bullish look with the moving average envelopes turning up and price above them? Or do we have a flattening out and rolling over look with price below? In the relatively early stages of this disaster, this big drawdown here, this look here with price below the moving average envelopes and the slopes down, it really doesn't look anything like the strong portions of the secular trend. They're almost polar opposites. So back to this question up here. There's no question that the monthly chart on August 8th, this looks a lot like this down here, and really doesn't look anything like this up here. Thus, these tools can help us under wildly bullish scenarios, help us stay invested, reduce our trading frequency, and maintain a prudent longer-term focus. And they can help us with this scenario, because even in the early stages of this drawdown, things start to look discernibly different. And as we're developing tools that help us monitor the strength or lack thereof of the secular trend, we want to do so with different looks and different settings. Similar charts, different settings. This is the look we want to avoid. This is the look we want to embrace. Exact same chart, exact same settings. This is the look we want to avoid. This is the look down here that we would want to embrace. How does the exact same chart look today? The chart speaks for itself. The previous charts were monthly charts. Most likely, we would be able to confidently monitor deterioration in a more rapid manner on a weekly chart. Weekly chart goes in the books every 5 trading sessions. Monthly charts don't get nailed down for 4 weeks. This is what we want to embrace. This is what we want to avoid. This is what the exact same chart with the exact same settings looks like in the present day. Compare this to all of this and this. And notice, in this case, it's a very strong trend, and we don't get any overshoots of the moving average envelopes, which is a little bit different relative to what just occurred in 2022. We have an overshoot. If we look at the exact same chart using the exact same settings in the 1956 to 1968 secular trend window, overshoot, 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 telling us this down here is not particularly alarming. In fact, we can learn something from it. During this secular trend, when you moved from here below and eventually made it back above, in every single case, A, the major low was in place, and B, the market continued to rally at a minimum for several months, and in some cases, over 2 years. In 2023, we've done that. This look speaks to probabilities based on these looks. You see an arrow like this. This is really just a notation for our modeling purposes. How does this chart look in the present day? It has a turning up and constructive look. Helps us with bearish outcomes, what to look for, and bullish outcomes, what to look for. This is the peak in the year 2000. This is after the major low in 2003, 2004. And this is what the exact same chart looks like in the present day. So weekly chart, let's move to a monthly with some different settings and compare it to the 2023 chart. This one doesn't look as strong as some of the other charts, but we can learn something. We're below the envelope here, September of last year, and now we're above the envelope and it's flattening out. How does that compare to the secular trend relative to the disaster look? Lower left-hand corner of your screen. It looks a lot like after the major low in 1982, after the major low in 84, after a major low after the 1987 crash, after the recession in 1990, after a period of congestion in 1995, and dropping below and then regaining and flattening out. Really doesn't look anything like this rollover look here in the year 2000 when we dropped below and really never recovered. From a money management perspective, always prudent to look at multiple time frames. Similar concepts here. This is what we want to embrace. This is what we want to avoid. And this is what the same chart looks like in August of 2023. The different settings and the different looks help us learn different things. Using these settings in 2022, we bounced at an upward sloping moving average envelope on the weekly chart. That's exactly what you would expect in the context of a secular trend. 1990, we came back and tagged and bounced after the economic concerns. Present day economic concerns, we come down at the exact same area, upward sloping and bullish, and bounce. This looks a lot more like 1991 and even looks more similar to 1994, 1995 relative to this look here. We bounce and almost immediately fail. 1982, we get a turning up look. After the 1987 crash, we get a turning up look. After the recession in 1990, we get a turning up look. 1994 is more of a flattening out look. And even here, price still holds near the moving average envelope and the slopes remain up. That's quite a bit different from what happens up here at the major peak in the year 2000. And the same chart today has the constructive turning up look, similar to this, and this, all occurring within the context of a secular trend. How strong the trend is here in the 1990s. Exact same settings. Look how strong the trend remained during the pullback in 2022. A little bit of an overshoot, and then we recapture. 1987 crash, a little bit of an overshoot, short stay, we recapture. 1990 recession, go to the lower band here, recapture. This and this look discernibly different from this, and this look, especially with the slopes being so strong here, squares up nicely with the bottoming process in late 2022 and into 2023, including just recapturing in the month of May. When you recaptured here, the low was in, good things happened. When you recaptured here, good things happened, especially from a long-term perspective. And when you recaptured here, good things tended to happen. And when you moved away, good things tended to happen. We've had 2 monthly closes above with that recapture look, and the slope aligns with, rather than contradicts, the secular trend thesis. So this look here is similar to 1987 to 1991. And you may remember we recently talked about that same basic window in a demographic video. And earlier in this video, we said there's some similarities to April of 1989 between 1988 and 1994. And you may remember, between 1988 and 1994, the median age of a baby boomer was 36 years old. Between 1988 and 1994. The median age of the largest demographic in the United States between 2022 and 2027 will be 36 years old, identical to the 1988-1994 window. It's also noteworthy, in 2023, all of the millennials in the prime working age window, some of them in the prime earnings window, and right behind them, another very large generation, Generation Z, to assist them walking forward. Typically, good things happen in the economy when large demographic groups are between 25 and 54, and even more so when some of them are in their peak earning and spending and investing years between 35 and 54. So the sweet spot, economically and for the stock market, 25 to 54. Here's where we sit today, 42, 27, 26, all of them in this window. 12 years from today, 54, 39, 38, and 23. This compares favorably, especially looking out over the next 12 years. That's where the demographics matter, not looking backwards. Over the next 12 years, the baby boomers will become less and less significant. The millennials and Generation Z, their significance economically will increase every year. These are very good-looking numbers between 2023 and 2035. 2022 to 2027, similar demographically to 1988 to 1994. And in that window, really good things happened in the stock market. Simply telling us to keep an open mind about a wide range of outcomes, including much better than expected outcomes. And we will always be looking for signs of this, and we absolutely positively will not be placing risk management on the back burner. We will continue to make prudent decisions based upon the charts and data sets in front of us. Every week we continue to study the charts, and every week a look like this, a short stay, upper end of the moving average envelope, nice slope. Every week we continue to find things that align with rather than contradict the secular trend thesis. Come back to a similar area and hold. These are the exact same chart settings. 1984, 1987, 1990, 1994. This is very similar to this. This is 2022. This is 2023. This is 1990. This is 1991. And this look and the present day look in August of 2023, both of them significantly different relative to this look here in the year 2000, 2001, and 2002. In subsequent videos, from time to time, we will continue to test the secular trend thesis and be looking for signs of significant deterioration. 1995 here, very strong trend. Price on the monthly chart above the Bollinger Band. Slopes, Bollinger Band, strong. This is almost the polar opposite of this disaster look over here. This is 2001 right here. Price, for the most part, is staying below the Bollinger Bands, and the bands are sloping downward. These tools are only useful if we can remain cool, calm, and collected, and that is especially true during 100% normal and to be expected volatility that occurs even within the context of the strongest trends. And secular trend doesn't even remotely try to hint at easy. 5 recessions in these windows here, one of them right here in 1990. None of them, 0, derailed the secular trend looks in this window and in this window. Stock market makes a lot of progress between the low in 1958 and the peak in 1968. And between point A and point B, there is 100% normal and to be expected volatility along the way. We have to trade and deal with the markets as they are, not as we wish them to be. The data that we have in front of us aligns with rather than contradicts the secular trend thesis. Pullbacks and corrections, unnecessary evil within the context of any trend. As always, the commentary is based on the charts and data in front of us. If the charts and data shift in a material manner, we must be willing to reassess the odds. We're not making any assumptions about any topic on any time frame. And as always, we're open to a wide range of outcomes, from wildly bullish to wildly bearish. If the charts and data start to contradict the secular trend thesis, we'll simply formulate a new base case. If we have a recession sometime in the next 18 months, history tells us that doesn't necessarily kill the idea of a secular bull market. Given what we know today, we can maintain a longer-term focus on a point B that could be several years down the road. Staying with that type of trend unfortunately requires discomfort from time to time and 100% normal and to be expected drawdowns. We'll see how things unfold, but most likely, if a recession is in the cards sometime in the next 18 months, that would require some adjustments to our allocations. And we all know the only way that we can do all of this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.